Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. With an early passion for video games and teaching himself programming languages like QBasic and C, Corey Hoffstein did not expect to ultimately wind up in money management. But exposure to various roles in the industry through an internship started him down the path, helping him see how to marry his love of computer science with markets. Now the CIO of Newfound Research, a firm he co-founded more than a decade ago, Corey is focused on delivering to investors the one free lunch they are entitled to: diversification. We spend most of the discussion here with an emphasis on return stacking, a strategy that Newfound embraces in order to expand access to diversifying assets. In this light, a topic we spend some time on is trend following, a strategy that is proven to deliver attractive, low correlation to stock and bond returns. Corey describes the manner in which the implementation of trend following is similar to the delta hedging of a long volatility position, allowing the strategy to provide some portfolio protection in risk-off events. And with risk-off in mind, we talk as well about liquidity cascades, research that Corey and his team have done to highlight the manner in which trades that live and breathe within the market's ecosystem of risk can create spillover effects that amplify asset price movements. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Corey Hoffstein. My guest today on the Alpha Exchange is Corey Hoffstein. He is the co-founder and CIO at Newfound Research, a quantitative investment management firm focusing on diversification, capital efficiency, and with a real focus as well on this concept of return stacking. Corey, it's great to have you as a guest finally on the podcast.
Dean, it's an absolute pleasure to be here. I just want to say right from the get-go that this has to be the number one podcast that I recommend to anyone. Usually it's on my highest list. So it's a privilege to be here. And that's coming from someone who, I guess in theory, technically hosts a competing podcast. So hopefully that means something to you. I think this is one of the best podcasts in the space.
Truly appreciated. We try to use this as an opportunity to essentially make a contribution to the thought process that we all collectively engage in and try to figure this stuff out. For me, markets are just humbling. There's just no obvious answers to some of the questions we face in the realm of risk and return. And so if we can put our heads together and have discussions like this, and these are useful in helping people think through risk, I think it's time well spent. So thank you for that. Well, you've got a great background. You've put a lot of time into the academic side, just in terms of computer science, computational finance. Tell us about the emergence of your interest in finance. Let's go back to the pre-crisis period, the pre-GFC period. You were hard at work in the lab, so to speak. So walk us through your initial academic background and how that became a starting point for embracing a career in finance.
It's a little bit funny. I guess I'm getting to that point in my career where people are starting to ask me for career advice and how I got started. And I find it actually a little bit insulting because I don't think I'm as old as I guess I actually am, or I've been around this for as long as I have, but the gray hairs on my head are starting to give away the lie. In truth, I accidentally fell into this industry. I had a real passion when I was young for computer games and video games, and I thought for most of my childhood that I was going to create games for a living. So much so, I taught myself how to program when I was 11 and 12. Learning QBasic. I then taught myself C and C++. I had this privilege in high school to go to an elite private school in New England, but I was there as a day student, which meant I ended up living about an hour to 2 hours away from all my friends. And on the weekends, when I didn't have a car, I couldn't get together with them. I spent the weekends programming and that sort of stuff. I was just deeply passionate about programming and video games, and I thought for absolute certain that is where I would spend my career. And so going to university for a computer science degree seemed like the very obvious path until I got there and started taking the courses and interacting with my classmates and suddenly realized, well, maybe no, this wasn't the sort of people I necessarily wanted to spend my life with. This wasn't necessarily the sort of thing I wanted to do exclusively. And at that point, it really just became a search. I didn't know what I wanted to do. I was fortunate in that my father's financial advisor said, "Hey, I know a bunch of people in the finance industry. Would you be interested in doing a 1 week rotation?" I had this great privilege of being able to go sit with a buy side asset manager who was picking individual stocks. I was able to sit with someone on the private equity side. I was able to sit with someone who was a venture capitalist. And I saw all these different angles. And I got really attracted to this idea of marrying what I saw the individual buy side asset allocator doing with what my passion was, which was computer science and figuring out how to marry those. I didn't know that was quant. Lo and behold, turns out that was just quant. And so as I explored more, I found this era of quant was starting to really pick up 2005, 2006. Ended up pursuing my master's degree at Carnegie Mellon for their computational finance degree, which is the oldest financial engineering degree in the country. It used to be much more sell-side focused. Pre-2008, a lot more focus on how do you price things like credit default swaps. The assumed career path was you would go work on Wall Street. Today, much more focused on the buy side, machine learning, finding anomalies rather than pricing derivatives. But really, my background was one that flowed naturally from loving computer science, loving programming, getting that spark for finance and trying to figure out how to marry them. And it opened up this world of quant to me.
So about Carnegie Mellon and this framework for courses that got you really started in the computational finance arena and pursuing a degree at an advanced level, you said the coursework was initially very sell-side focused. It's gravitated to become more buy-side focused. Talk a little bit more about that. I'd be curious to learn more, perhaps, about the focus on, as you say, data sets, machine learning. What's been the evolution? And if you can, has there been an acceleration of this evolution over the past couple of years? It'd be great to get your thoughts on that.
Yeah, so these degrees are really targeted degrees at someone who doesn't want to stay in academia. They want to go and become a practitioner. And so placement is obviously really important. Pre-GFC, a tremendous amount of the placement was to go work at the banks. Typically in some quant role, the ideal role was a sales and trading desk placement. That's what everyone was hoping for. And so a lot of the education, it's a cross-disciplinary education, computer science, mathematics, really focused on stochastic calculus, statistics, and then general finance knowledge. Those four fields come together at Carnegie Mellon to put this program together. Most of it, when I went through the program, was very focused on the stochastic calculus side. How do you price complex structured products? How do you price some of these exotic derivatives? When you're exiting the program, really the whole idea was most people were going on a very traditional Wall Street bank path. The world changes. Obviously, post-GFC, a lot of those jobs disappeared. A lot of those desks got downsized. And so to continue to have strong job placement, universities like Carnegie Mellon and other great programs like Berkeley and Princeton had to start to look to the buy side. And the buy side was asking for a very different set of skills over the next decade. It was much more data set driven. It was much more understanding about factors and portfolio construction, much less emphasis on things like C++, much more emphasis on things like Python. And so as you would expect a program that is very focused on ultimate career placement and career trajectory, they've had to shift their focus, which I think is great. That's exactly what these types of programs should do. When the demand in the market changes, they should adapt. Now, the core philosophies largely remain the same. It's finance, mathematics, programming, statistics. It's just the emphasis of how those are applied that ultimately shifts over time.
It's so interesting. You mentioned coursework in calculus and statistics and these sorts of core disciplines that are often learned and mastered by those, as you said, are folks that are pricing things like exotic options and different structures that make their way into Wall Street trading desks. And here we are, Corey, celebrating the 50th anniversary of Black-Scholes, the seminal paper from 1973. And I always find It's interesting to think about the Black-Scholes formula in the context of the equal sign that comes with the formula. Under this set of assumptions, you can exactly calculate the price of a call option or a put option. It's not debatable. It's got an equal sign. And so with the assumptions, you've got actually the solution to a formula. And I just wonder if you can reflect on that, just as you think about the disciplines of math and statistics and how they work their way into Wall Street. We price these structures, out pops a number. We imply that there's some truth to that number. We ran through the equation and you get truth through this formula. And I've always thought that was a little seductive to some extent, that people believe the model a bit more, perhaps much more than they should, and don't pay attention to the various and very important frictions that we encounter all day long in markets. I'd love to get some of your thoughts on that. I know we're going to circle back to it in some of your work on liquidity cascades, but as we think about the modeling of complex structures versus what you've seen in markets, share some of your perspectives, the relevance, where things can break down. What are the implications of the vast degree of modeling that goes on in markets?
I think this is a powerfully important point. I think there is a seduction in the perceived accuracy of a lot of decimal points when we do quantitative work. We can take our estimate out to a large number of decimal points, but it belies the fact that there is definitively in any sort of modeling work a shroud of uncertainty. There's a distribution there that we have to be aware of. It doesn't matter how many decimal points something goes out to, it doesn't make it necessarily more accurate. You can be incredibly precise and incredibly inaccurate. I think the people who are really, really good in this space inherently understand the limits of models. They understand what the purpose of a model is. One of the things we're initially taught is Black-Scholes. It's one of the foundational models in the quant finance space. Almost anyone who goes through a quant finance education is going to learn Black-Scholes, and then you're immediately taught about all the unrealistic assumptions that are there. But at the end of the day, Black-Scholes is just a pricing formula that gives everyone a common language of convention. It's not right or wrong. We can still use it to derive implied volatilities that give us a common way to communicate as an industry, even though the underlying assumptions are definitively wrong. Obviously, the vol surface isn't flat, but that doesn't really matter all that much when it comes to just having a standard way to quote things. So I think there are nuances to this question. Even if a model is wrong, can it still be useful? Absolutely, particularly if you know why it's being used. I think what gets really interesting to me is when quants at large begin to adopt similar or the same models, and I think you see this on the buy side a little bit with factor equities in particular, or risk models, that they all unintentionally converge upon the same solution and can end up being overly crowded in a position that actually leads to more risk across the street. And I think that's a really interesting place for models, because one of the things we do tend to see in the industry is that models evolve, best thinking hopefully evolves, and people try to adopt the newest, best modeling, but in many ways, those ideas often converge into the same space. And that convergence, I think, can be potentially dangerous for the stability of markets at large.
I think crowd is this elusive to measure, but clearly such an important concept. You can either crowd into something or you can crowd out of it. It's the behavior of investors in aggregate that you've got some part of this analyzed in your liquidity cascades work. You call it coordinated risk in an uncoordinated way. It's the aggregation of behavior, certainly of similar behavior, that can really ultimately become problematic. It certainly can mask real risk. So we'll definitely talk a lot about that. And I wanted to go back to this Black-Scholes concept and broaden it out a little bit to talk about VAR, value at risk, because it's a similar sort of framework and it's some version of a normal distribution. I've always found it problematic when someone says, well, my 2SD risk is this. And even as that person acknowledges and says, well, I also know the tails are fat, I know I can't take this literally, because time and time again, you see the negative skewness in asset returns, but they still do it. So there's some comfort in being able to say that, I don't know, 2.5% of the time, I'm never going to lose more than X. And I just wonder if the neatness of this normal distribution construct and the takeaways from it that we can have just from here's what it implies from how much risk I have on the sheets. Ultimately, it's about sizing. And I suspect frameworks like VAR can mask certain risks. How do you see it?
Well, I'll try to answer this with a heaping tablespoon of humility, because I think someone like Aaron Brown, for example, who's argued in the past that VAR is useful, certainly has far more authority than I do on the topic. I think the reality is when you get into the trenches, topics like VAR that are maybe initially taught and measured through the normal distribution, in practice, in my experience, rarely are done so at the practical level, because people absolutely acknowledge the inherent risk of fat tails in markets. As a great example to this, the SEC recently introduced what's called the 18F4 rule. So this applies to mutual funds and ETFs who are using derivatives. In the past, it was hard to get an understanding of what sort of the appropriate risk limit for derivatives was within a mutual fund or an ETF. The SEC didn't have incredibly clear guidance. This new 18F4 rule provides very strict guidance to users of derivatives, and it's based on VAR. And what's interesting about the regulation is they give some guidelines as to how that VAR can be calculated, at least some minimum ways in which they expect it to be calculated, but then they largely leave it open to the chief derivatives risk officer at each firm to implement the idea as they see fit. We were of the view that the minimum implementation that the SEC allowed was not a useful implementation. It would have allowed us to adhere to what the SEC's standards were and maybe just barely jump over the bar that they set to be in line with regulations. But ultimately, if you're going to have a risk measure, you want that risk measure to be useful. One of the things Aaron Brown said in his book, Red-Blooded Risk, which is probably one of my all-time favorite books I've ever read in this space, is that for a risk measure to be useful, it ultimately has to surprise you. And so I think people often think of VAR as a number that should never be exceeded. I think by definition, VAR should be exceeded. It's then a question of what do you do once VAR is exceeded, and what is your conditional expectation of how you then have to update your VAR for that changing market environment. One of the things he talks a lot about in that book is the idea of risk ignition. It's just as bad to not take enough risk as it is to take too much risk. Both of them ultimately can lead to failure, just leads to failure for different reasons. It's all about finding the balance of how much risk you want to take. And so with these risk metrics, the idea isn't that they're so stringent that they take away our permission to take risk, but they also can't be so loose all the time that we're taking too much risk. It's in finding that balance. And I do think, at least in my experience, people acknowledge the reality of fat tails. People understand that they're out there. They try to address them in a number of different ways, whether it's through simulation with empirical data or looking at past drawdowns or making different correlation assumptions when they're modeling a portfolio to stress test. All that stuff I've found plays into VAR numbers I've seen in the real world. They're all wrong. Again, no matter what number you come up with, it's definitionally not the right number. It's just a question of whether that number is still directionally useful.
Exactly. Yes. So while we can't see religion in these numbers, they should be some signpost for the degree to which risk taking is on track. And I'm just remembering, as we look back on the 50th anniversary of the Black-Scholes formula, it's the 25th anniversary of LTCM, and this might be a little bit before your time. But by May and June of 1998, long-term had breached their VAR limit a couple of times. And I don't want to say they paid no attention to it, but clearly they didn't take it as seriously as they ultimately needed to have to prevent this giant portfolio unwind. So that's going to lead us into this conversation on some of the work that you've done specifically on liquidity cascades, and certainly LTCM was some version of that. But before we dive into some of the work that you and your team are doing, tell us about Newfound Research. It's a firm that you co-founded more than a decade ago. Tell us about the mission. What is the firm putting out there in terms of its clients and its deliverables?
Yeah, I appreciate that opportunity. So Newfound Research is a firm I started back in August 2008. So we're about to hit our 15-year anniversary. Again, when I talk about my career trajectory and it being a little bit laughable that I can give career advice, the firm was largely started accidentally. I was working on some quantitative models. I met an asset manager who was interested in licensing those models. I was on my way to grad school, candidly needed some beer money. We slapped together a contract. I named the company Newfound after a lake I used to go spend my summers at in New Hampshire. That was that. I never expected it to amount to anything. And lo and behold, 15 years later, we're still here. I would say the mission of the firm has changed, though. We went really from a firm that was primarily focused on delivering quant research to we do now operate as a more traditional asset manager. Our tagline goal as a firm is to help investors unlock the benefits of diversification. I think for us, hard stop diversification is the only free lunch that investors have. It is probably one of the most important driving elements in their portfolio results. For anyone who's operating in a world where they are constrained by time horizon and wealth targets, diversification is critically important. And so the question we've asked ourselves for the better part of a decade is, why don't investors introduce more alternatives into their portfolio? Why do we find for the financial advisors that we work with, the portfolios are still predominantly dominated by stocks and bonds? And the answer we came to is that there's this ultimate funding problem, that for an investor to introduce an alternative, they have to sell some of their stock and bond exposure. And if we look across the aisle to what institutions have done for decades, they've been able to use capital efficient instruments like swaps and futures to get access to beta, freeing up cash that allows them to then introduce those diversifying alternatives in this portable alpha methodology. What we're working on doing is delivering that same concept, but wrapped up into mutual funds and ETFs so that financial advisors and individuals who can't manage derivatives programs for a variety of compliance and operational reasons can still introduce those concepts of capital efficiency and bring those alternatives into their portfolios as an overlay, retaining that core bond and stock beta that's so important to them. That is our mission today, helping investors expand their palette of investments, helping them introduce these alternatives as an overlay through a variety of capital efficient strategies.
Well, just a quick aside, I would just say that a lot of the work that folks like you are doing is starting to make its way into the dialogue, and it just takes a long time for folks to feel comfortable enough, for their advisors to feel comfortable enough to make a change. And as you said, people have been beholden to some version of the 60-40 stock bond combination for years and years. It's what you see. It's what CNBC reports on each day. It's just a familiarity effect. And I don't think it should be understated how important that is. For me, my own tenure on the sell side, I've hosted a lot of discussions around utilizing derivatives. And oftentimes my audience has been the cash equity community, just trying to help play a role in educating them on the products. So I remember probably it's 2007 or so, I was doing a talk to a long-only mutual funds, and I had done some Google searches on utilizing derivatives for mutual funds ahead of this talk. And I came across something that I think read something like this. It said, the work that the sell side is doing in terms of education is starting to bear fruit with regard to educating the long-only community. We're seeing an uptick in adoption rates from traditional vanilla investors who are using strategies now like overwriting. And I said to myself, wow, this is gold. I'm so excited. This is so relevant. And then I looked right at the bottom of the piece was the date. It was from 1995, 12 years earlier. So it's always a long and lengthy work in progress. But you point to the advent of ETFs and essentially a product that helps democratize something that has been more the stomping ground of basically the high end of Wall Street. As you said, these big access products like 130/30 through swaps and so forth, those have been around, but now you've got these ETFs and they can enter really far along the path of what has previously been just, again, accessible to the highest end of the money management community. So ETFs are really about access. And one of them, and I'd like you to talk a little bit more about this and use it as a chance to walk through some of the work you're doing on return stacking. But it was just fascinating for me to see that there's a 60/40 portfolio ETF that simply applies 1.5 times leverage. That's it. And it's actually quite useful. It's something that we now have access to. We see it on our screens. Our Fidelity accounts are used to having ETFs like this. They can trade on a screen very easily. So I don't think that can be understated. We may not be creating something brand new here, but it's certainly making the exposure easily accessible, much more easily accessible. And I think that's pretty important.
Yeah, so that is actually one of my favorite ETFs. If you were to ask me to name a top 10 list of ETFs, that is one of my favorites that's out there. Kudos to Jeremy Schwartz at Wisdom Tree for breathing life into it. It actually has a pretty funny origin story. So the ticker of that fund is NTSX. It is the Wisdom Tree U.S. Efficient Core ETF. Full disclosure, Newfound uses that ETF in some of its model portfolios. As you mentioned, it's a 90/60. It's a 60/40 portfolio. For every dollar you invest, they put 90 cents in large cap U.S. equities, and they hold 10 cents aside as cash collateral for a ladder of U.S. Treasury futures. On its face, I think what happens a lot is people look at that portfolio and say, is this a better growth portfolio? Cliff Asness at AQR actually wrote a paper probably in 1995 or so called Why Not 100% Equity? And he showed how actually a levered 60/40 was a better portfolio to hold for institutions than a 100% equity portfolio. The original idea behind this ETF actually, somewhat funny enough, came out of a whole bunch of Twitter conversations between myself and two anonymous users on Twitter. Jeremy Schwartz jumped into the conversation, thought it was a great product idea, and was able to bring it to life. But the idea there wasn't to say, if you're a young growth investor, instead of being 100% equity, you should be a levered 60/40. It's a more diversified portfolio. The idea was to say, if you're a 60/40 investor, what you can now do is sell some of your stocks and bonds, replace it with this ETF, and you will need less of this ETF to get the same core stock and bond exposure. And whatever position you free up in your portfolio, you can then introduce an alternative. And in effect, because the funding rate in U.S. Treasury futures is tight enough to cash, you're effectively getting the excess return of that alternative. So as an extreme example, let's say I have 100% of my money in a U.S. 60/40 portfolio. I could liquidate that entire portfolio and put 2/3 of my money in this ETF. 2/3 times 1.5 gets me back to 100% fully invested in a 60/40. I now have 1/3 of my portfolio left over that I could invest in anything, theoretically. Now, I have strong views about what should and should not be invested in. For example, I'm a large proponent of managed futures as a diversifying strategy to someone who already has a large stock and bond exposure. But let's say you were to put that 30-year portfolio into a managed futures fund, you would now effectively have a 60/40 plus the excess returns of that managed futures fund on top at a 33% notional allocation. A pretty extreme two-fund example of how it can be used. But I think for investors who have historically been leverage constrained, advisors who don't have access to derivatives, individuals who don't have access to derivatives, suddenly ETFs like that and the types of ETFs that we're bringing to market enable a whole new frontier of portfolio construction.
What I like about your work is that there's a lot of intellectual honesty. I'll read back to you a question you posed in some of your writing on return stacking. You wrote, quote, "Where does this run into trouble?" ? And you said, "Are we simply harvesting another risk premium?" So talk to us about that, how you think about the question of whether you are indeed just layering risk on top of risk. Obviously, you're giving this a lot of thought. Walk us through how you think about it, the additional allocation of capital that gets freed up through the leverage, and then the pursuit of return through that. And then your question, where does this run into trouble?
So before we started recording, we were chatting about some of the pithy statements that I've become known for, at least in certain circles. And one of them is this quote that I use all the time, which is, "Risk can't be destroyed, only transformed," which I came up in parallel to, I think Chris Cole at Artemis says something very similar about how volatility can't be destroyed, only transmuted through time and space or something. But the basic idea here is that we shouldn't be able to make changes to our portfolio in an efficient market without a trade-off of risks. It's an idea that originally came to me in my graduate studies. When you go through that study of learning to package and structure a product, to me, it became all about how do you package risk, how do you price it, and how do you isolate and trade it to people? That's what Wall Street is all about. With that framework in mind, when you look at something like return stacking, the question to me becomes, okay, what risk profile are we changing? And do we think that in the long run, that's to our benefit? I think we have to acknowledge first and foremost, anytime you introduce leverage, you are introducing a path dependency. There is that risk of a margin call. And I think where we saw portable alpha go really wrong in the 2008 crisis is people were under collateralizing their capital efficient positions, their futures and their swaps, and they were investing the freed up capital into hedge funds that were illiquid, which prevented them from rebalancing or redeeming to help right side their collateral. So I think first and foremost, we need to acknowledge that leverage needs to be used correctly. We shouldn't be using leverage to double down on the same risks. Ideally, what we are doing with something like return stacking is using that leverage to introduce diversifiers that are going to be structurally or statistically uncorrelated to what we're doing with the rest of our portfolio. For example, if you hold core stocks and bonds like most people do, those tend to do well during periods of real growth. They tend to suffer during bouts of inflation volatility. What I would look to do is try to fill out the rest of my portfolio with things that are going to do well during those periods and not necessarily be a drag on the portfolio during other periods. But we have to acknowledge we're introducing a new diversifying return stream. And I think the name return stacking helps clarify that there are going to be environments where if it's an uncorrelated return stream, it might be down at the same time the core portfolio is down. You're just adding two things. You're stacking the returns. And in that sense, you are potentially creating more risk in certain environments. The way I like to think about these things mentally is that the risk we have is like this big ball of Play-Doh. And maybe you've got a 60-40 portfolio and all of that risk is in an economic contraction, inflation volatility type regime. Ideally, what we're doing is we're taking a whole bunch of that Play-Doh and we're smearing it into other regimes. None of the Play-Doh disappears. The risk is all still there. We're just now making it so it's less material in different places. And I think in doing so, when you go through the math of compounding and why diversification is so important, you can end up with a higher expected long-term terminal wealth through this diversification exercise, but you're not necessarily eliminating risk. You're just moving it into different regimes.
You mentioned in your example utilizing that freed up cash through the 1.5 leveraged 60-40 ETF, and then potentially deploying that capital into future strategies, trend following strategies. And I saw in your paper the correlation of some of these trend following strategies to the market as a whole, to certain value factors, quality factors, impressively low for sure. And I'd love to have you talk more about that. Maybe the results specifically, and then what do you take away from the results of these impressively low correlation? Because of course, that's the Holy Grail. The Holy Grail is to be able to formulate a portfolio where the constituents are delivering some positive return, but aren't really moving together. And certainly the pieces you presented, you've got something pretty attractive, at least on a backward-looking basis, with regard to low and sometimes even modestly negative correlations.
So this is something I could probably spend a good hour on talking about, maybe the capital market assumptions of trend following. This is a passion of mine, but we'll try to keep this brief. So let me high level say, if we looked at the empirical historical returns of trend following as a category, you get a couple of really interesting things that come out. One, it has on average positive returns. So that's attractive. It's not necessarily historically been a drag on returns. Excess returns, that is, once you subtract the cash component out. 2, historically low correlation to stocks and bonds. And then 3, it's historically done well during periods of significant equity crises as well as bouts of inflation. So to your point, this does seem like the holy grail. I think what's important here, whenever I think about introducing a new exposure to my portfolio, the lens I try to look at it through is this an asset class that derives its value from fundamental cash flows? And therefore, do I expect correlation properties to come from those cash flows? Or is this an asset class that is generating its returns through some sort of trading strategy, that the P&L is actually not coming from any sort of fundamental exposure, but it's actually coming from the actions of the strategy itself? And if that's the case, how do I expect that to behave relative to the other assets I have exposure to? If we look at trend following as a strategy, you actually get a little bit of both. So let me explain what I mean by that. If I were to build a trend following strategy, very generic trend following strategy, I would give you exposure on a risk-weighted basis. About a quarter of the portfolio would be in global equities, global futures, equities, global bonds through futures, currencies, and commodities. And if all the trends are positive, assuming everything has a positive trend, which might be the bias thing those risk assets have over time, then what you would get is something that actually looks very much like a risk parity portfolio. Maybe the currencies don't exist in most risk parity portfolios, but you get this risk-weighted blend of stocks, bonds, commodities, and the currencies are in there as well. And so from that perspective, before I start talking about the actual trading strategy itself, I can say, okay, this looks like a risk-weighted basket of global risk assets. I expect there to be a positive risk premium from holding that. But I don't expect it to be uncorrelated to stocks and bonds. I just expect there to be a positive risk premium from this strategy. So then I have to think about, well, what is the actual trading strategy that's happening here? And the trading strategy, going back to Black-Scholes for a second, the trading strategy of trend following is very simple. It says, when the price has been going up, we want to be long. When the price is going down, we want to be short. Well, depending on how you implement that, it actually ends up looking a heck of a lot like the delta replication strategy of a straddle. And so in many ways, what we're doing when we're holding a trend following strategy is we're basically holding a risk parity portfolio, and then we are synthetically constructing all of these straddles on top of it. And so you might then say, okay, if that's the case, depending on, again, there's some nuances here as to how closely that replicates a straddle. But I would say, okay, I get risk parity plus a straddle overlaid on top. That sounds to me like risk parity minus a bit of a protection premium plus some protection in the tails. That is kind of the return profile you see from managed futures over the long run. So it aligns intuitively. Then the question becomes, well, is there a way to actually harvest some alpha? Do you, in synthetically replicating that straddle, are you actually paying an insurance premium like you would if you bought the straddle outright? Or are there people in these markets on the other side to whom they're passing you some alpha because they are suppliers or producers or actual consumers of the commodity, and you are earning a liquidity premium for participating in the market in tail events? Well, that's up for debate. But I think the core philosophy of trend following, what to me makes it so interesting, is you combine this basket of risk premia generating assets plus the synthetic trading strategy that I think very intuitively should give us participation on the upside, protection on the downside. And we would expect, at least on average, might be a little bit of a negative alpha for the protection you're receiving.
Yes, I think this idea of synthesizing option-like payoffs without actually trading options is a really interesting area for exploration. Cam Harvey, the academic professor who did some of the earliest work on modeling the yield curve as a predictor of recession, he's been a guest on the Alpha Exchange and caught up with him recently in Chicago. And we talked about some of his work in trend following. And again, just this idea of the conditional performance of this trading strategy in downturns is impressive. we're all looking for those trades that stabilize in a risk off. So we look back on the data and we all should be, of course, humble in the sense that the backward looking slice of data is just a moment in time, but that's the reality. I always use this as an example, so my listeners are probably bored of it, but in 2016, when we were backtesting being long vol, we didn't know that 2017 was about to happen. And 2017 was, I want to say, a 6.8% realized vol in the S&P for an entire year. Your backtests are only up to a point in time that you have the data available. You don't know what's actually coming. And that's where I wanted to ask you, where I wanted to steer the next question is, before we go into some of your work on liquidity cascades, one of the things you do in talking about return stacking is you say the greatest concern to adopting return stacking is a rapid collapse in diversification during extreme market events. So again, just being humble about what we don't know. As you look at managed futures and trend following, is there any sense that the strategy itself could at this point be so well adopted? You alluded to this earlier, that if enough people are doing the same thing at the same time, then the AUM itself becomes a little bit of a part of undoing the benefit. And I think that's the question. Has it gotten to the point where it's large enough or too large where it essentially undoes itself in terms of its benefits? Are too many people using the strategy at the same time for defensive purposes?
I think that was one of the key arguments against managed futures, or at least trying to explain the performance of managed futures over the last decade. If you look at it as a category, managed futures had one of its worst realized excess returns in the 2010s. Now, I will say that it was still positive. It was just very meager. What we saw post-2008 was the really rapid adoption of this strategy. Hundreds of billions of dollars poured in. And if you try to do the work to replicate the aggregate strategy performance, one of the things that comes out of that work is you find that the average speed of trend following seemed to slow down. That as these trend followers were ingesting all this new AUM, they were forced into the larger contracts within the programs. They might have access to hundreds of futures markets. There are trend followers who explicitly only work within alternative markets like French electricity. But when you start talking about the category as a whole, so much AUM went in that they're forced to trade US Treasuries, they're forced to trade equities. It gets more financialized. There's less access to things like the agricultural sector, where it's much more capacity constrained. And so as an aggregate industry, things slowed down and things got more concentrated into the same exposures. I think that does, to your question, raise a point of whether things will work in the future as an industry. If you are running a slower trend following program, that is effectively like replicating a longer dated straddle. You wouldn't expect the same convexity in a rapid sell-off as you would if you were running a faster trend following program and replicating a shorter term straddle. Now, the trade-off there is in the longer term straddle, maybe you're not paying as much in trading costs. So you might not protect against the short term stuff, but you might protect against long term sell-offs. It's also a trade-off. I don't think, I will say, that AUM has gotten to the point that it is so capacity constrained that it's going to eliminate any benefits from trend following. But I do think we have to be very clear that performance that we see, say, pre-2008 versus post-2008 might be very different in the industry as a whole because of the way the industry had to shift in the types of contracts it was trading, the type of exposure it was able to provide in aggregate on average, and the types of trends that it is now following. I just think we have to be aware that the profile may be different, and we can't necessarily rely on those pre-2008 returns as being exemplary of what we would expect going forward.
So before we go on to liquidity cascades, I had one other question that I had written down, and we saw each other at the Macro Minds conference. You heard from Cliff Asness. And for me, it was fascinating to listen to him, obviously overseeing quite a large pool of capital, AQR, and being humble about what markets can impose on us. And certainly that 2020 to 2021 period with regard to the value factor being trashed certainly tests even the most disciplined factor-based risk manager. COVID was such a profound shock to our lives, to markets, and the way we work, the way we live. And certainly market prices really moved to a dislocated extent. The differential between expensive and cheap got to just an unbelievable level. And so what I found really interesting to listen to Cliff on was observing and experiencing the negative P&L of being reliant on a value factor that had really suffered during that period and trying to understand if the model still works. And he said, if you can't test the thesis, it's just not worth it, right? So you've got to find a testable thesis to be able to explain it away. And as you know, the value factor had come back. It certainly lost a little bit since that period. But I'm curious in terms of your view on the factors, things that you guys look at. What is, from your perspective, the current state of pricing in the common factors? Anything especially anomalous for you with regard to main factors like value, momentum, quality? How do those work their way into your process, and what do you see there?
This is a big open-ended question. When you look at these different factors, I think one of the key questions you have to ask is, what's the turnover rate? So when I look at something like momentum, which has a signal that the alpha decays in theory very rapidly, needs to be traded very frequently, I don't really care so much if the basket it puts me in is in a very overvalued basket. That's the nature of the trade. Value as a signal tends to be very slow. So trying to forecast the return of the factor itself using a signal that's very slow when the portfolio could be incredibly different within a month doesn't make a lot of sense. This is something Rob Arnott talked about this back in 2016. It set off a whole maybe Second World War between Cliff and Rob, firing papers back and forth. Actually, Rob was just writing papers. Cliff was firing them at Rob, and Rob was never responding. But the large point Rob was trying to make was that if you look at the valuation of all these factors, especially defensive, low vol, very overvalued. And Cliff's point was value works over a horizon that's so slow, you need the portfolio turnover itself to be on that horizon, or else who cares? It doesn't matter that low vol is overvalued if the low vol portfolio is going to look very different in 6 months. That's all to say, when I look at the way all these factors are aligned today, you do see some interesting things. You saw over the last year quality, value, momentum align and overlap in a way that they historically really haven't. Got a 2000, maybe dot-com fallout type event period where you started to see these things align, but it's very unusual for the factors to have that much overlap. Value itself, from a value spread perspective, still looks incredibly cheap. Things started to revert and then they bounced back. I think when you have value spreads this wide, it will just take a long time to converge. I don't think this is an overnight event. You could see value have tailwinds for years. And I think what's particularly unique is that because value spreads are so wide, you could actually have momentum and value, which have historically been very different baskets. You could have them be converging on the same names for a very long time. And that's because when value starts outperforming, those outperforming names end up in the momentum basket. But because value spreads are so wide, those value names have a long time to run before they get into the growth basket. And so you could see, in theory, managers that have historically offered a lot of diversification from one another, momentum and value, actually have a tremendous amount of overlap in their portfolio. And so that's one of the risks I'm looking at among equity quant factors going forward, is just recognizing with the value spread being so wide, it could lead to some interesting unintended bets in multi-factor portfolios, as well as across different single factor implementations.
Really interesting. And I mentioned that value was on its back by late 2020 and into 2021. It started to make this comeback, as you noted, but still remains very cheap as a factor on a historical basis, even amidst higher interest rates, which to me is surprising. So we spend a lot of time learning about markets and thinking about causality. And oftentimes we spend maybe too much time on it, trying to force narratives that help us make sense of markets, maybe they more so than they actually do on a daily basis. Okay, so let's shift to your work on liquidity cascades. You brought a lot together in terms of how to think about this across the products that get introduced into markets. We certainly talk a lot about options on this podcast. So, what brought you to this topic? What got you so interested in this notion of liquidity cascades? I'd be curious as you think about the relevance of the potential for future events now versus when you wrote it. Has anything changed in terms of, I don't know, market microstructure? Walk us through the big picture of your work, and then we'll drill down on some of the questions that you pose.
Before I even begin here, I really just want to make sure I give due credit. A lot of the ideas in liquidity cascades of the paper that I wrote in 2020 were not new and novel concepts. These were ideas that many people in the industry had been talking about for quite some time. So folks like Chris Cole and Mike Green, Jem Carson, Ben Eifert, these are all folks who have been talking about a lot of these ideas. And my apologies to anyone who I'm leaving out there. But the point I'm trying to make is the paper that I ended up writing was really more a synthesis of many of these ideas rather than anything new and novel coming from me directly. So why did I bother writing it in the first place? What got me interested? In truth, it was the March 2020 event. From the seat I was in, at least in my perspective, what I saw was an exogenous event that should have clear market repricing impacts from a fundamental perspective turn into a very violent endogenous event. That markets started to move far faster and in far wilder directions day to day than I think could be reasonably explained by the fundamentals. And it caused me to take a step back and say, okay, are there pieces that I'm missing that would help me understand the way modern markets operate, if not over the long term, at least in the short term, particularly in these violent moves? And so that led me on a sort of multi-month exploration of many of the different ways in which people were trying to see market impacts. And there were really three big camps that emerged from the literature that I was reading. The first was people who were very focused on the influence of central banks. The second was people who were very focused on the growth of passive and ETFs and how that was impacting market microstructure. And then the third was people who were focused on the growth of volatility contingent strategies post 2008, including things like risk parity and managed futures that take vol as an input to adjust sizing, vol selling programs, the way in which options are being used and traded by broker dealers, structured products, all that fell into that camp. And what I found is all three of those camps were very strongly believing that their explanation was the right explanation. And as I took a step back, the narrative I proposed in the paper was, well, these are all influencing each other. The actions of central banks may be driving market participants to adopt certain types of strategies. Those types of strategies may be causing investors to move into crowded positions, may be reinforcing low vol in certain environments and leading to an explosion of vol in others that ultimately crystallizes in central banks having to intervene again, and it becomes this cycle of influence across these topics. And so what I was trying to propose with the paper was this bigger narrative connecting these pieces. Now, the last thing I will say, and I think I mentioned this in the introduction of the paper, is that while I put these ideas forth, I never explicitly say which ones I believe and I don't. And I've had a lot of people ask me, well, which ones of these do you believe is true and which ones do you not? Again, very much like the beginning of our conversation, the narrative precision with which I lay them all out, I like to at least consider there's a large shroud of uncertainty around all of them. I have some conditional probabilistic views about which ones I put a higher certainty on, but none of them am I 100% certain on. I think they're all worth considering, though.
Yeah, so Chris Cole comes up a lot in playing a real nice role in helping describe maybe the ecosystem or the taxonomy of short vol. And of course, he's got his analogy of the Ouroboros, really well-constructed thought process around what I would just call the internalization of short vol within the market. And I'm just remembering he had made a really incredible prediction. I think when he wrote his paper, I'm going to say it's around 2016. So vol was low, but on its way to going even lower. He said that the market would experience both an all-time low in implied vol and then an all-time high in implied vol. And both of these, incredibly, in 2017, the all-time low, and then by March of 2020, the VIX got to 83, a new all-time high. So both of these actually came true. Of course, it took a pandemic to get the VIX to 83. But I certainly, Corey, look at March of 2020 as no doubt a giant shock to the system. We're shutting the economy down. The unemployment rate was set to head to 15%. There's no more earnings. The economy is shut down. It's not something you've experienced before, but it's difficult for me to get away from just how violent these daily moves in the market were. And I think the conclusion shared by many is that the trades that lived in the market, let's just say by February of 2020, were some version of a contributor to how violent these swings were. We know about incredibly large losses in short equity vol and risk recycling strategies. Those were tremendous. Hedge funds, pension funds as well. So I'm pretty sympathetic to the notion. As well, things like vol contingent strategies, central banks playing a role. Another guest has been Vinir Bhansali, who did a lot of work in that pre-pandemic period that we've been talking about. And what Vinir essentially argues is that straddles were being sold as an income generation tool. So in a world of 0% interest rates that seem to have no end in sight, folks were selling straddles to try to effectively create some interest income. Well, when the VIX goes to 9.5, that implied vol takes the option premium down by so much that you've got to sell a boatload more straddles to get you your same level of desired interest income. So there's a lot of reflexivity in the land of vol. And so also walk us through how the growth of passive investing impacts some of this concept of liquidity cascades. Mike Green has done a lot of important work on this. As you look at the passive investing side, let's say then versus now, is that any different? Does that trend continue to be a real important factor in markets for you?
Yeah, I think there are two sides of this passive story. And I think Mike Green touches upon it really well. You can just, anyone who doesn't know Mike, give Google, you will find a whole lot of media about his discussion around how, as market participants have moved from active to passive, what sort of influence that creates on markets in aggregate, as well as individual securities. The basic idea there being, and my apologies to Mike if I oversimplify this, but there's two major effects. One, the average active fund holds more cash than the average passive fund, which means that if there's a large migration from active to passive, there is an increase in aggregate demand without being an increase in aggregate supply, which should structurally shift valuations upwards through price. It's not like earnings are coming down, it's price moving up as people move in aggregate from active to passive. And that's simply just a function of more cash being put to work, and therefore you need prices to be higher for that math to make sense. So that's a market-wide phenomenon. The second point Mike would make is that when you then have continuous flow, what is happening with that new money being put to work? Consider that when I entered this industry, target date funds were sub $10 billion. They are now north of 3 trillion in size. They are become in the zero interest rate world the default savings vehicle, a tremendous number of Americans. And every month, money is being put to work automatically in these 401k plans going to largely passive fund families that are following glide paths with no regard for fundamentals, largely investing in very passive exposures like the S&P 500 or Vanguard Total Market Fund. As that money comes in, if you take $1 and go to invest it in the S&P today, well, 6% of it's going into Apple and Microsoft and Google and Facebook. All those large cap tech names are seeing continuous disproportionate demand relative to, say, an Under Armour who's going to get far less than 1 cent of flow. And so the argument is basically, as continuous flow comes into the market, it's creating a wedge between the demand for those higher cap tech names and the lower valuation names. So Mike would argue potentially that this could lead to a move in which you basically get runaway valuations in these large cap tech names because there's not enough people out there to do the work to drive the valuations back down relative to the structural demand that is coming from passive flow. So that's one big side of the passive conversation that Mike is having. The second side, to me, is a market microstructure question, which is we have moved as an industry largely to trading ETFs and baskets of stocks. Those ETFs are being traded by just a handful of market makers. Those market makers are trading with significant amount of leverage, and they are ultimately capacity constrained during periods of crisis. So one of the things that I think went largely overlooked in March 2020 was, I believe it was Virtu put out a press release saying they were trying to raise $300 million in capital just so that they could continue to make markets. It wasn't that they didn't want to, it's just that for them to be able to make markets posting securities as collateral with the amount of leverage they need in volatile periods when securities are collapsing in value, they need more capital to be able to make markets. Those market makers, I think, are incredibly important infrastructure, and we have seen them continue to consolidate, and they are largely the only ones trading all these baskets, and that can potentially, in extreme market environments, lead to situations where they are just unable to trade these baskets efficiently and lead to potential price distortions.
There's a book from a while ago written by China expert Michael Pettis, also really a European and emerging markets expert as well. And he wrote a book called The Volatility Machine. And it's a really interesting read. I think it goes back to this notion that markets are a constant feedback loop. And so a nod here to reflexivity and George Soros and this idea that markets move around for a lot of reasons, but sometimes, again, it's the actors and the trades, oftentimes carry trades that live and breathe within markets that matter as well. And of course, leverage becomes a part of this. It's just amazing to me, just our ongoing learning process in markets. And at each turn, we learn something new. And it's a feedback mechanism from price to volatility, and then into our own internal distributions that we map around what's possible. So with that, I just wanted to ask you, as we round out this conversation, for you to just talk a little bit about your research. What's on your mind now of the stuff that you and the team are working on? Clearly, you're continuing to do work in this idea about return stacking. I've read some interesting stuff from you guys that talked about rebalancing luck. I think that's also a really interesting topic. As you said, you're not going to get compensated for stuff that's diversifiable, so you should work to diversify it away. What else is on the research docket for you as we look at things to study? What are you working on?
Well, you hit one of them that is a pet favorite of mine, and I know you had Ronnie Israel on the podcast a while ago where you talked quite a bit about the paper he and I co-authored on rebalanced timing luck. I feel like Don Quixote tilting at windmills. It's something I've been writing about for over a decade now. I think it is one of the most important influencers on the dispersion in returns among managers and the counterfactuals of the returns you could be realizing. And no one talks about it. I will continue to write on that topic. My guess is my gravestone will say something to the effect of he was passionate about rebalanced timing luck and convinced no one. But we'll carry on with a good fight. Other than that, though, there is this topic that I have been thinking a lot about as we talk about return stacking, which is the idea of strategy versus structure. What I see in the financial advisor community is that they have largely come to believe that the ETF is a superior vehicle versus the mutual fund. And the reality is that's not always the case. The ETF was able to take off, in my opinion, largely due to the tax loophole that is embedded that allows active equity managers to push out in kind to market makers low basis securities and be able to have high degrees of turnover without any realized capital gains. That is a massive innovation from a structure perspective and hugely powerful for compounding wealth over the long run for investors in taxable accounts. The reality, though, is that is not necessarily the best vehicle for which that sort of thing does not apply to a strategy, because for that structure to work, the market maker has to be intimately involved. And the market maker has to feel comfortable hedging the ETF, and they have to go through the create redeem process. And so you introduce this entirely new participant into your strategy who doesn't really care about your strategy. What they care about is their ability to hedge your strategy. And that puts all sorts of constraints. So for example, let's say we'll use managed futures. If I wanted to run a managed futures program that was only trading alternative markets, I didn't hit any of the major liquid futures contracts, I only wanted to trade really obscure markets, it would be impossible in an ETF. And so as I think about return stacking and I think about trying to bring these diversifiers in a capital efficient way into ETFs and mutual funds, it is this process of trying to find where are the limitations of certain strategies. And if you start to introduce those limitations because of the structure, is the strategy still viable? I will say that I had a conversation with a potential sub-advisor recently about a systematic macro program that they run. Incredible track record. And we went through a long exercise of asking whether they could put it in an ETF. And the answer ultimately was no. For the type of signals they're using, the type of turnover they need, the type of markets they're trading, the ETF was just the wrong structure. And I don't think that's an incredibly sexy answer. Certainly it's not as sexy as AI and machine learning, but I think it's a very pragmatic problem in terms of bringing new product to market, really making sure the strategy and structure align with each other so it's a maximum efficiency solution.
Well, that's a great point. There's certainly allure to ETFs. They're easy to trade. We see them flickering on a screen each day. And so it's all very easy from an access standpoint, but that doesn't necessarily mean that they're entirely suitable for every strategy. So important point there. Well, Corey, this has been a great conversation. I'm really glad we had an opportunity to do this. We can find your research on think.newfound.com. Some really thoughtful papers there. So keep on writing and contributing to our understanding of this stuff. And it's been great to have you as a guest on the Alpha Exchange. Thank you.
Dean, it's been a real pleasure. Thank you for having me on.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.